Howdy. Welcome back to Dion Talk. It's interesting when everything we see says there's a crash coming. There's a stock market crash going on. There's going to be a real estate correction. Interest rates are going up. The idea is the Fed wants to curb inflation. So we have this inflation going on while we have a supply and demand issue with housing. Decade by decade, the number of houses that we've built in the last 40 or 50 years is continuing to grow, except for the last decade. It's literally a fraction of what we did the 10 years before. So we have a supply issue. We're not making as many houses, which is one of the things that came up in the video this morning that kind of bothered me. Was the guy said there's a massive flood of inventory that is coming because builders aren't going to be able to sell their houses because rates went up, so people can't buy them now. So they're going to have to lower their prices value by 50%. The lack of logic there was stunning. So there's massive demand. People have money to deploy from the last 2 years. And the biggest shift from the pandemic, people can work from home. So instead of sitting in a city and paying $3,000 or $4,000 a month for a crappy little apartment, people can move pretty much anywhere and work from home. I actually met with a guy today, Bill. It's not that he was in a city living in a crappy little apartment, but he can work from home, which meant he could move home where housing prices were decent and he can actually buy a house. And comparatively to what he would have paid living in a city where he would have had to work before he could work from home, the price is much better. So there's a ton of demand that isn't going anywhere. There are a lot of investors who watch content like this that are looking for the next great deal. So we're not going to see a massive price correction. And Michael Zuber gets us right, just based on his knowledge, that it would pretty much be impossible by the end of this year for us to see a price reduction. We're going to see a crash in transactions as some people lose the ability to qualify for the amount of money that they were looking to spend. So they're going to have to adjust their target area, maybe expand their circle into places that aren't as a high cost of living area, or stay where they're at longer because they don't want to sell the property that's got a 2 or a 3% 30-year fixed rate debt locked in, because now they want to move to a bigger house, which would cost more, at a higher rate, which would cost more. So they're going to stay in their house, eliminating their sales transaction and their purchase transaction. So hopefully people understand when we see a lot of videos that are accurate that call for a real crash, they're talking transactions, not price. So as an investor, what do we do when prices continue to go up and rates increase, which increase the cost to us as a buyer, and rents are lagging behind? Rents are going up. And last year and the year before, we saw rents skyrocket because wages set rents. Wages actually set prices too. And we're seeing record wage inflation. So part of it is people can move wherever they want and purchase. But a lot of that increased rental demand too, because there were a lot of people who worked for companies like Pinterest in San Francisco, pays $89 million to break their lease, gives employees $20,000 to relocate. But people aren't sure that in a year or two, things might change. And then you go back to being called to work into the office. So a lot of those people were renters who are now realizing we're not getting called back to the office. Whichever company they work for is deciding we're going to stay with this model. It's better for employee retention because some large companies have forced people to come back to the office and only half or 40% did. The rest joined the great resignation and changed companies. So now those people can become buyers from their work from home options. The other day I made a video on how to run the numbers on a house hack. It was a live stream. I just wanted to say, this is what was in my mind. Here's how it works. And really what I did is I said, here's how you run the numbers on a rental. And then when you run the numbers on a house hack, you remove the elements of a house hack to where you're basically running the numbers on a rental. It's pretty much what I'm doing here with this video. As rates go up, as prices increase, we do the same thing. Continue to save. Every time you save money, you increase your options. You have more money for down payment, closing costs, immediate repairs, and those reserves that lenders are going to want you to have. As you save money, more and more options open up to you. As your savings gets large enough, you have more options, like maybe doing a BRRRR method instead of an investment, maybe doing an investment property instead of a house hack. You have more options open to you. So that never changes because we're always saving while we're looking for the next deal. It might take longer as there's transactions that decrease. You're going to continue to work on credit, always with the goal of getting to 740 or higher so you get the best rates and best options, especially when lender fears start to get higher than they are now. They're going to be more strict on their lending options. So you want to have your credit as high as possible. you need to talk to a lender currently, like almost weekly. What are my options with this income, this work history, this credit score, this amount of money saved for down payment and reserves based on current lending percentages? Because there's a lot of people right now that have a pre-approval from a month and a half ago that are not going to have that amount as a pre-approval because interest rates have gone up so much. So know currently what your options are with a lender. Step number 4 is talk to your agents, the ones who have your auto searches set up, and make sure that your searches match what you can do. So those first steps are the same, whether we're in a buyer's market, seller's market, or right now when the pendulum is kind of wiggling in the middle and we're not sure where it's going to go. Do the same steps. Nothing has changed. Learn your market. So this will come from the conversation I had with Bill today. But this conversation today was great because the options aren't always to buy an investment property. When does a house hack look more attractive? Because sometimes a house hack is the primary thing that most of us talk about is reducing or eliminating your housing costs. That's like the main thing a house hack does for you. But it's also low down owner occupied lending. So if you're in a house and you're looking for a rental property and you don't want a house hack, you don't want shared living space, you don't want to do what I do where I live in a unit of a fourplex and I'm super cheap. I actually rent out a room in my unit of the fourplex because I like getting paid to live where I do. If you don't want to do any of that and you don't even want to live in a house with an ADU and even have just people on the same property, like neighbors, but just on your property, you can't do any of that. There's a version of house hacking where you live in a house. You purchase another house with an owner-occupied loan, which means you intend to live there. You can do 3.5% down FHA, 3% down conventional if you haven't owned a house, but if you're moving out of one, you can use a 5% down conventional to move, which is, in my opinion, better than FHA for a few reasons. One, you don't have to worry about the 4-3-2-1 method of FHA requirements of always moving towards a single family house or a bigger single family house. You can actually go from a single family to a duplex and use conventional loan. But in this case, if you were to purchase a house that you move into and turn your old house that you were living in into a rental, there's the benefit of house hacking without needing to save up the money for a down payment. And as prices and rates increase, sometimes the best thing to do is try to get the best rates. When we own or occupy a single family, we get the best interest rates. So buying a house and then turning your house that you have into a rental might be a better option. If you're familiar with my content, I didn't have a good debt to income ratio and I had a lot of bad debt and I wasn't making a lot of money. So what I did is moved from my house into an apartment and rented out the house for 2 years to get rental income on my tax returns. So that when it was time, when I took the time to save up a down payment, I was able to buy a duplex using the rental income from the house and the other side of the duplex in my debt to income ratio, getting rid of problems like debt to income and low income as far as qualifying for the loan. So you have a bunch of different options, but you need to also stay on top of the rents in your area. When we hear things, and this is ridiculous, when we hear inflation is at 7 or 8%, it's so flawed because here's how they're doing this. And this blows me away. I got this. I'm surprised I didn't get this from One Rental at a Time because now that I go back over some videos, he has mentioned this several times, but I heard it from Minority Mindset with Jaspreet Singh. When they run inflation to figure out how much rents have gone up, I mean, they factor how much fuel is and how much food is and how much these different things that have expenses have gone up. When they factor rents, they actually contact homeowners and they ask them, owner's equivalent rent, what do you think you could rent your house for? And most homeowners don't have a clue. Instead of, not maybe daily, but at least weekly, you should go to apartments.com, Craigslist, Zillow, Facebook Marketplace in your area that you invest and see if you were trying to rent a place like the ones you're trying to purchase or trying to rent out, what are current rents in your area? Because in the inflation numbers that get us to that 7 or 8% that they quote, they're talking about rents going up 4%. In my area, which is Washington State, rents increased 20 to 30% at tenant's request. So that's me using the binder strategy where the tenant requests the rent increase. So imagine what the rents are actually increasing where property managers just say, here's what area average rents are. That's your new rent. If you like it, great. If not, you can move and we'll have a tenant turnover. One of the reasons I don't have property management is because tenant turnover is one of their profit models. As an owner, I don't want tenant turnover. So save, credit score, lender, agent, the same steps when rates and prices aren't going up, learning the area average. Because and you have to know what the current area average is. That's impacted by rates, prices, and rents. And if you're not tracking rents, you don't have the whole equation. So anybody who's saying prices are so high and rates are so high, I can't buy. If they don't know what the rents are, I don't care if I have 50% interest. If it can get me the yield that I'm looking for, I don't care how much money goes to the lender. The tenant's paying that. I want my yield, which is the profit divided by cost to acquire.
I hope you enjoyed this clip from one of my long live streams. I do my live streams every Tuesday afternoon at 4 p.m. Pacific, and they last as long as the questions do. You can find the entire video here. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.